Chapter 5, Depreciation. Depreciation is considered the loss of value of a piece of equipment or real property. When it comes to the study of depreciation, we will see that depreciation is important primarily for three purposes: to indicate the amount of loss of value of the assets owned by the construction company on the financial statements, also to allocate cost as part of the equipment expenses, and also to allow the construction company to calculate for taxes. So the depreciation is an important aspect of financial management for business in general, as well as construction companies. These will not necessarily be the job of the construction manager, but primarily if you are a business owner, you will most likely have to hire the services of an accountant or a CPA to provide depreciation calculations for the company. But it is an important aspect of financial management. The business owner will or should be aware of how that depreciation is calculated. There are several variables that you will see in your chapter, with the letter P starting with the purchase value, letter F with salvage value, and the salvage value is the book value at the end of the useful life of the asset. For tax purposes, that salvage value or book value is considered to be zero at the end of the useful life. Now, we could have a piece of equipment, say a pickup truck, that it could be classified as a 5-year asset. That doesn't mean that the truck will stop working after 5 years of its allowable depreciation period. Simply, for tax purposes, we will consider the salvage value of that pickup truck to be zero. Okay. If the company were to sell that pickup truck at the end of the 5 years, well, certainly they can get more than $0 for that truck. That is what we would consider the market value of that particular piece of equipment at the end of the 5 years. So the market value could be higher or lower than the salvage value. Okay, it does not necessarily mean the same thing. Letter N is the recovery period. That is the number of years that the asset will be in service. And for tax purposes, we need to identify that, and the IRS or Internal Revenue Service will give us specific tables, a specific number of years for the different types of assets used by construction companies. Another variable is the percentage of depreciation taken in year M, or in other words, at the end of every year. The depreciation for every year also as D sub M, and the book value at the end of every year, B is the book value, which equals the purchase price minus the depreciation recorded to that date. There are a number of different methods used to calculate depreciation on assets. And by the way, assets could be equipment owned by the construction company. It could be real property like buildings or farm buildings or warehouse buildings, and they are all subject to depreciation. The only type of asset that is not subject to depreciation is land. The cost of land does not depreciate. Okay, going back to the different methods of depreciation, you will see in your textbook that there is a straight line method, which allows a uniform depreciation of the asset over the life of the asset. Okay, there are some formulas that you will see in your textbook that will allow you to calculate the depreciation And you can see here that the straight line method allows you for a constant depreciation. In this case, 110,000 purchase value asset depreciate at a steady rate of $20,000 per year. Another method is the sum of the years method. This is a method that allows the depreciation to be accelerated. In other words, as we can see here on the table, we can see that there is more depreciation on the first year of the recovery period, or after year 1. So the depreciation varies, it's not constant. Again, please review your textbook for the formulas on how to determine the sum of the years method. The declining balance method is the third type of method. Okay, again, it allows for an acceleration on the depreciation. Within the declining balance method, we have either the 200% declining balance or the 150% declining balance. There are, again, formulas in your textbook that would allow you to calculate depreciation using this method. The declining balance method does not automatically reach a zero salvage value. Okay, there has to be some adjustments, and here's an illustration on what we see using the declining balance method on a $110,000 asset. We see how steadily the asset depreciates until it reaches year 3. On year 3, we need to make an adjustment and use from year 3 to year 5 the straight line method in order to allow us to reach to a zero value or a zero salvage value. Okay. The last method is the modified accelerated cost recovery system, or MARCS, also known as the IRS method. This is the method that is used by the IRS, and you can see here that is actually a combination of the declining balance method and the straight line method. Okay. Under the IRS method, there are a couple of different options depending on when the asset was placed in service. You could use the half-year convention, the mid-quarter convention, or the mid-month convention. Again, the Internal Revenue Service provides recovery periods for specific types of assets. Okay, this is certainly not an accounting class, but I think it's important to be aware of that these assets are identified in the tax code. Depending on the asset, they could be classified as a 3-year, 5-year, 7-year, 10-year recovery period. For example, heavy general purpose truck is going to be considered a 5-year asset, whereas office furniture or office equipment will have a 7-year recovery period. Not necessarily related to standard construction companies, but perhaps more with marine type construction companies where they will own vessels, barges, or tugboats. Well, those assets are subject to a 10-year recovery period. Farm buildings, 20 years. Municipal sewers, water distribution lines are subject to a 25-year recovery period. Non-residential real estate, 39-year, and so on and so forth. The use of depreciation tables, again, under the IRS system, you will have to identify the correct table, identify the correct recovery period for the asset that's in use, and determine the percentage of depreciation for the asset value for that particular year. Again, please refer to your textbook and the examples in your textbook, for how to calculate depreciation under this particular method. Here an example of the declining balance method, or IRS method, using the half-year convention. Okay, again, we see that if we're dealing with say a 5-year asset, we'll see that the percentage of depreciation for year 1 would be 20%, for year 2 32%, year 3 19.2%, year 4 11.52%, year 5 11.52%, and year 6 5.76%. You will always see these when you use the IRS method, is that there's always an additional year to be calculated in order to reach the zero salvage value. So if you're calculating a 5-year asset, you will have to calculate all the way to year 6. If you're calculating a 10-year asset, you will have to determine the depreciation all the way to year 11, and so on and so forth. Okay. One last thing is the Section 179 of the tax code. It allows companies, and this is for 2010, so I am sure for 2013 these numbers will be different, but back in 2010, companies could expense up to $250,000 of equipment without depreciation, meaning that you could see it as a fully accelerated type of depreciation, where companies can take the full expense on the year that they apply that expense for tax purposes. Okay, one of the advantages of calculating depreciation is that it is going to allow companies to reduce their tax burden. So if they can reduce it, instead of prolonging the depreciation, say between 3 to 5 years, if they can reduce the depreciation to, say, the first year, that certainly has some tremendous implications in terms of reducing the tax burden for the company. Okay, thank you for your attention, and we'll see you next time.